Good afternoon or good morning, depending on where you are. Welcome to our investor call briefing covering the first quarter of the 2018 financial year. I'm Chris Andrews, Chief Investment Officer here at Trobe Financial, and it's terrific to see such a large number of people from across Australia and internationally joining us again today. A few points of housekeeping, as always, before we begin. These sessions are designed to encourage questions, so you should be able to see on screen where you can type yours. I'll answer as many as I can at the end of the presentation on a first-come, first-served basis. But with the numbers attending today, of course, I mightn't be able to get to all of you. I'll finish this session promptly at 12:30 Australian Eastern Standard Time, but I'll follow up individually, of course, with anyone that I've missed. I should also point out that I will not be commenting on individual portfolios or assets today. As always, our investor sales team is ready to assist you on those matters on our free call national number 1-800-818-818. As a final point, I'll note that this presentation is actually accredited for CPD points with the MFAA and FBAA, so please email us at marketing@latrobefinancial.com.au and we'll send those details to you if you so require. So, on that note, let's begin. Today's investor call will provide you with our current view of the key issues driving investment opportunities for you. First, we'll look at the macroeconomic landscape with our headwinds and tailwinds report. Our repeat listeners will be very familiar with that format now. Secondly, we'll update you on interest rates and the residential property market in particular, both perennial items of interest for our investors. Finally, we'll review the quarterly performance of our $1.8 billion La Trobe Australian Credit Fund investment accounts. So plenty to get through, lots of interesting discussions coming. So please, as I said, feel free to forward any questions that you might have as they arise. So let's get going with our headwinds and tailwinds report, our macro view of the domestic and global economies. And the first point to note is that when you think about La Trobe Financial, we continue to sit on the more optimistic side of the spectrum, if you like, when you consider the economic commentariat generally. Over the last decade, we have seen commentators line up almost monthly to predict the next economic catastrophe. From house prices to sovereign debt to ageing populations and economies, there's no end of potential causes and catalysts on offer. Now, like a broken clock that's right twice a day, eventually one of these doomsayers will be right. We will have a recession. That's absolutely certain. That's what happens to economies periodically. In fact, every single economy in every single period of economic history has its share of challenges and imbalances to address. But the Chicken Littles, in their ceaseless search for the next headline, always shed more heat than light. So today what we're going to do is cast a realistic eye first on the challenges that face our economy, and there are plenty of those headwinds, but also the positive signs, the tailwinds, and there are plenty of those as well. So the first headwind that we'll look at is household indebtedness. Now, debt levels are high. We've heard that a lot in recent times. Whilst households are currently meeting their obligations in aggregate, higher debt levels do make an economy more vulnerable to shocks. That can't be denied. It should be noted, however, that Australia's peer group is amongst Australia's peer group in the highly indebted, if you like, are some of the strongest economies in the world, Switzerland, the Scandinavians, and you should also note that most of the increase in household indebtedness has come from New South Wales and Victoria, our strongest and most diverse economies. It's also arisen amongst the most wealthy households, the fourth and fifth income quintiles. Broadly speaking, our debt levels are closely monitored and highly regulated. Much of the work of the last 3 years by our financial regulators has targeted controlling orderly debt levels. Now, in its latest financial stability review, the RBA has again signalled a really clear focus on strengthening the resilience of the balance sheets, focusing on orderly management of debt. So the necessary steps are, of course, a drag on economic growth, and therefore we've got it down as a headwind. But continue to watch this space. As recently as Monday this week, APRA Chairman Wayne Byers publicly confirmed that APRA is looking to step back from its current degree of intervention in credit markets. As long as credit standards remain strong, and the chairman confirmed that things are moving in the right direction on that front, we are moving to an environment in which current restrictions are no longer needed. The second headwind is stretched government balance sheets. So in a recent speech to a group of superannuation investors, former Treasurer Peter Costello observed with some surprise, could I say maybe even a little bit of perverse glee, that he had not expected that the budget surplus of 2007, which of course was used to seed the Future Fund, he did not expect that that budget surplus would be the last surplus for more than a decade. Now, it's true, of course, revenues fell in 2008-09 by 2.6%, and then again in 09-10 by 3.8%. That, of course, followed the global financial crisis. But the following 3 years saw revenue growth of 8%, 9.8%, and 6.6% respectively. Now, the last 3 years have seen revenue growth slow but remain positive. Despite this, we see Commonwealth deficits stretching into the future. 2020-21 will be the year for the next surplus, according to the latest budget estimates, and these have proven to be very, very optimistic in the past. So query whether we will actually deliver on what's forecast there. Our states are performing a little bit better, but it's clear that in aggregate, our government sector balance sheets will be a drag on the economy in the years ahead. Now, a significant contributor both to household debt and to government deficits is low wages growth. Since late 2012, annual wages growth has plummeted from sort of circa high threes to really down to the ones, high ones. For the June 2017 quarter, the figure was up a little bit, but was still just 1.9%. We're getting the lowest prints of annual wages growth since the early 1990s. Now, this has been a surprise to many economists, given near full employment in the economy. So it's likely that underemployment, spare capacity in the labour market, on screen there as underutilisation rate, it's likely that this is a key cause of the issue that we're detecting here. And that's a theme we picked up in our last investor call briefing. The effects of low wages growth are significant. It will result in time in lower consumer spending, thereby leading to higher unemployment in the short run, less resilient households with a reduced capacity to repay debt, and of course lower tax receipts for the government. So it's not surprising that the Reserve Bank has singled out weak income growth as a key issue in its financial stability review. Our fourth and final headwind is one that we've commented on before, so another issue that we are seeing as a recurring theme, and that is low productivity growth. Now, we've previously discussed that the decline in productivity growth has been seen across the world as well as here in Australia, and there are competing theories as to actually what is going on here. Now, one theory is that the slowdown reflects the fact that the really big productivity wins come from tangible factors that are actually already locked into the economy. So think about roads, cars, running water, electricity. On this view, living standards are just actually going to grow more slowly into the future. A second theory is that productivity is not being measured properly. Entire industries are being transformed in ways that are very hard to account for in traditional data. How productive were the staff at Facebook last year, for example? Very difficult to measure. A third theory, of course, is that productivity growth is simply being held back by current economic conditions, lack of investment, which in turn is being held up by low demand, low economic growth. Whatever the cause, there is a very strong basis for arguing that this is one of, if not the most significant issue facing the global economy. It's been said many times, for economies and in the long run, productivity growth is nearly everything. And on this measure, for now, whilst we've improved a bit since the absolute depths in sort of the wait immediately before, through and after the GFC, for now, Australia is languishing with the pack. So those are the headwinds. Let's now turn to the tailwinds, starting with Australia's extraordinary runs of 26 years of continuous economic growth. It is an extraordinary fact that over a period of time that has included some of the biggest regional and global economic shocks ever seen, Australia's economy has continued to power along without a recession. Not the Asian financial crisis, not the dot-com crash, not corporate collapses like we had here with Ansec, Pasminco, HIH, not even the global financial crisis itself were enough to tip us over the edge into recession. Now, some argue that we've been fortunate to benefit from strong population growth. Some have argued that we've been fortunate to benefit from hitching our wagon, if you like, to the extraordinary China growth story. To an extent, they're right. But we have also had model policy making from an independent and effective Reserve Bank, a very well-regulated financial sector, and we've maintained a lifestyle that many around the world continue to regard as world-beating, and that's something to celebrate. Second, whilst we've already seen the growth of labour underutilisation, all other key labour market indicators are actually very strong. The unemployment rate is dropping steadily, and last week surprised the market by dropping again to 5.5%. Job vacancies are at all-time highs. Employment indicators from the NAB survey are at their highest level in a decade, and net employment growth continues to accelerate. On these figures, it's not unreasonable to assume that pressure is building on wages growth. What we really want to see, though, is that just starting to break through into the wages growth prints. The third tailwind that we will consider today is Australia's growing population. Australia's population growth is among the highest in the world and is currently sitting around 1.6% year on year. Now, it's true that there's been some significant underinvestment in infrastructure by governments, both state and federal. That's put some parts of Australia under pressure. There's no doubt about that. But in the long run, this growing and increasingly diverse population base will generate critical mass in our economy to support additional industries. It will build our connections and understanding of our regional neighbours, our trading partners, and it will put a rocket behind our economic growth. So for us at La Trobe Financial, the growing population in Australia is very much an economic tailwind. The final tailwind has the potential to be the biggest tailwind of all. There are some indications, tentative and mixed, but there are some indications that the global economy might be turning the corner. Take a look at the progressively strengthening positivity of the IMF World Economic Outlooks as this year has gone by. Now, I say again, the story's been mixed. Some countries have underperformed, others have outperformed, but in aggregate, and noting continuing challenges, there are some signs that the developed world in particular is picking up pace. To an extent not generally realised by the investing public, Australians benefit from a healthy world economy. Now take our super system, the so-called Trump trade, which has seen US equities grow strongly over the 12 months since President Trump was elected, has reaped enormous benefits for Australian super funds that have a lot of their international equities exposures in the US. Super rating CEO Jeff Bresnahan pointed to this sort of outperformance by the US equity markets in reporting on a great year for superannuation fund returns up to the end of the 2017 financial year. So in a sense, every Australian who's invested in these large superannuation funds has benefited in the hip pocket from the election of Donald Trump. Focusing then on the US in particular, we see mixed signs, but some cause for optimism. Unemployment is at a low 4.2%. GDP growth is at the highest level since 2014, and GDP per capita is now well beyond pre-GFC levels. Payroll data is bucking that trend with a negative print in September. That's the first fall since 2010, so must be noted. But don't forget that this came on the back of serious hurricane activity. So we would want to see this become a trend before we hit any alarm buttons. So we retain our broadly optimistic basis about the Australian and global economies at this time. None of the headwinds can be ignored, but there is appropriate capacity to manage them. And we remain optimistic about the long-term trend of the Australian economy in particular. So, turning now to topics of perennial focus, interest rates and house prices, always very topical amongst our investors. Longer-term followers of our thinking will recall that in mid-2014, we predicted that interest rates would remain around their then current levels for the next decade, plus or minus 0.5% from the then prevailing rate of 2.5% was our specific call. In making this prediction, we were reflecting on the entrenched and persisting low growth environment we were observing globally. With ageing populations, high debt levels, it was difficult to see inflation re-entering the system in the same way that it had done prior to the GFC, at least into the medium term. Of course, our prediction was very promptly T-boned by a Reserve Bank that in May and August 2016 concluded that persistently lower than expected inflation and pressure on our currency, the Aussie dollar, this warranted a further reduction to the cash rate. Now, these moves, of course, were not without their critics, but if anything, they re-emphasised the challenges that regulators face in reintroducing growth and inflation into world economies. For this reason, whilst we'll concede on the terms of our prediction, our conviction on lower interest rates for longer has, if anything, been strengthened. Again and again, we see predictions of coming inflation dashed on the rocks of reality. Yesterday's inflation print of 1.8% once again surprised the market, which had been expecting 2%. This pattern has been repeated too many times to be ignored. As we sit, underlying inflation remains below the RBA target range. Whilst there are some signs of an increase in inflation, inflationary pressures, if you like, building, this is off a very low base indeed. The RBA has rightly expressed a bias towards moving rates back towards historical norms. That's right in our view. But given the structural features of today's global economy, we think that any upward movements, they will be slow, they will be steady, and they will be very, very measured. Turning to house prices, it's now well established that the rate of house price increase has peaked and is declining, very much in line with the targets of the financial regulators over the last 12 to 18, even 24 months in particular. For the first time, the previously bulletproof Sydney market is seeing month-on-month declines. Now, don't read too much into this. Admitted they are of minuscule proportions, these decline. Year-on-year outcomes are very strong, but nevertheless, there is still a clear change of direction in Australia's larging housing market. And frankly, at La Trobe Financial, we welcome this. Broadly speaking, the rest of Australia is flat with the exception of Melbourne and also Hobart, which is experiencing an extraordinary boom of its own. Clearance rates are down across the board, which of course reflects the less active markets. I say again, don't overplay what's happening. Last weekend's results, as reported by CoreLogic, gives Sydney's clearance rate as still a very healthy 69%, actually somewhat up on previous weeks. But you still do see that as being well down on the 80% plus clearance rates seen in previous months. Melbourne's clearance rate is still solid at 73%, but it once again has shown signs of softening from its peak levels. Now, this is consistent with our long expressed view that Sydney and even Melbourne could do with a little bit of cooling when it comes to house price growth. I repeat, as we've repeated many times, we still do not see any evidence to support a thesis of disorderly collapse in housing values. Demand for new housing via population growth continues to increase and is centred on these key eastern seaboard cities, and Melbourne in particular as we speak. The ABS is continuing to predict a dramatic increase in the number of households in Australia. In fact, they're projecting a 37.2% increase in the 20 years to 2036. This demand is supplemented by strong overseas interest. Australia's big cities are now competing for the global property purchaser, and Credit Suisse recently estimated from New South Wales State Revenue Office figures that offshore purchasers are accounting for a massive 25% of new residential stock purchases. And that's even after the Chinese capital controls, which have been introduced in the last 12 months or so. Clearly, the demand picture is very strong. In fact, in our view, the more pertinent medium to long-term question is whether supply can keep up with this demand. Dwelling commencements increased in Victoria, New South Wales and Queensland since 2010, but they are now showing signs of declining, and it is far from clear that they will be able to keep up with the burgeoning demand through population growth. Deloitte Access Economics is the latest organisation to try and estimate the demand-supply balance equation. Their graphs on screen, you can see it's actually a very difficult process. But whilst commencements have surged in the last few years, that followed a significant period of undersupply. And honestly, the demand and supply lines are currently converging again back towards the crossover point where demand exceeds supply. This issue will bear close watching in the months and years ahead. As a final point, it's worth noting that some recent work published by the Bank for International Settlements has continued to find, as many studies have in the past previously, housing has been an excellent investment across many countries on a multi-decadal time horizon. So if we focus just on the advanced economies, and they did a similar analysis for developing economies, but focusing on the advanced economies, Australian housing has delivered a stellar 8.1% return on a per annum basis over a 55-year time period. That is serious compounding. Some international markets, Spain, the UK, New Zealand, Italy, Ireland, some have done better. Regardless of the rankings, it's worth noting that the housing market has been extremely robust, very resilient, and a great performer across many economies for many, many years. For that reason, we continue to have faith in the value of quality property as a long-term investment proposition. And we now turn to an update on La Trobe Financial's offerings. Investors in our classic 48-hour account have been awarded with a 3.2% per annum return from what was at the end of September 644 individual loans running at an average LVR of 66.9% per annum. That's a benchmark outperformance of 1.7% per annum, noting that we, of course, benchmark classic against the official cash rate. Turning to our 12-month term account. Now, 12-month term account has continued to be the flagship for many investors in our credit fund. It has nearly $1 billion in funds under management across, at the end of September, 1,945 individual loans with a weighted average loan-to-value ratio of just 63.3%. Its highly diversified portfolio has an average investment size of just $449,000. So a highly, highly diversified portfolio. The 12-month term account is benchmarked against the Bloomberg Ausbond Bank Bill Index plus 1.5% per annum. It's currently outperforming this benchmark by a whopping 2.02% per annum. And as you can see from the graph on screen, it's been able to maintain this consistent outperformance for a very, very long period of time. In fact, in terms of the stability of the return of the 12-month term account, the last rate adjustment was in September 2015. So this is a highly stable yield-based investment offering that we're delivering here for investors, which is, of course, extremely pleasing. We continue to operate Australia's largest peer-to-peer offering through the Select Investment Account with $384.3 million in first mortgage secured loans. This account offers investors the ability to choose the individual loans that suit their own needs and objectives. Investments can be chosen on borrower or security characteristics, loan-to-value ratio, yield, duration, whatever characteristics are important to the individual investor. It's a great and flexible tool, one that continues to attract a lot of attention. The shopping list on our website offers outstanding peer-to-peer functionality, and we'll have more enhancements coming in the months ahead. It's also the only independently rated peer-to-peer offering in the market, so that is a powerful plus. The high yield investment account offers both bespoke mezzanine investment opportunities, second mortgages and the like, again on a peer-to-peer basis, and a portfolio of credit assets that's currently delivering 7% per annum for a 3-year investment. Really powerful investment offering there, and one that continues to attract a lot of interest from our investors and partners. So on that note, I'll turn to you, our listeners, and I'll try and address as many as I can of the questions that have come through. So allow me just to flick through to those. And we have a question from Peter here first. And Peter is asking, on a geopolitical basis, what do we see as the likely effects for the economy and for La Trobe of a war in North Korea? Thanks, Peter. Well, that's the big question. Look, the North Korea situation is it's not going to surprise anyone if I say it is an extreme concern to markets globally and to the world economy. For Australia in particular, well, South Korea is a very important trading partner of ours. We've got sort of exports something like $18 billion with South Korea, and they're probably our second or third highest or largest trading partner. So certainly anything to the extent that affected the South Korean economy, that would have a direct impact, particularly on industries like steel, aluminium, beef, the sorts of industries that have significant exposure to South Korea. From sort of the broader knock-on effects, if you like, from a serious conflict in North Korea, obviously global financial markets would likely retreat to safety. So that would be, a significant disruption to those global markets. And it's fair to say at the moment the attitudes of markets generally has been not to price in any real probability of this sort of event breaking out for a few reasons. Firstly, it's very hard to get a handle on how likely conflict is. Obviously the regime in North Korea is behaving in ways that are difficult for us to predict and to assess. And secondly, the range of potential consequences is just so broad that it's very difficult to make sort of a rational assessment as to how that should affect pricing. So the nutshell is this is an extremely uncertain event for world markets. At the moment, economies, financial markets are positioned as if a way will be found through this North Korea crisis, but it's certainly something that will attract continued attention, and we'll be watching it very closely in the years ahead. Now I have a question from Chris. Do you think that the abolishment of stamp duty concessions for off-the-plan investments will have an effect on house prices? Yes, yes, it will have an effect. If you believe that price signals have an effect, then you would believe that this will have an effect. It may have, of course, the question is, will it have the effect of increasing prices or decreasing? Obviously, it's been brought in an attempt to, take the heat out of this sector, if you like. The problem is that it's attacking demand. It's attacking demand for new housing stock, and there's a very strong case that if you attack the demand for new housing stock, there will be less housing stock brought on, which means a lower supply of housing, which of course perversely results in an increased house price outcome. So that's Chris, I think a very quick answer, but one that I think shows the difficulty of these sorts of interventions which target the demand side of housing in an attempt to reduce pricing. Do you have any predictions as to what can happen to our economy after the next federal election in Australia? And that's from Jay. Well, that's a very good question. I think in our headwinds and tailwinds report, I sort of outlined some of the key challenges that Australia's facing. We have an infrastructure deficit, but we have a budget deficit, and those two issues are contradictory in many ways. What I think as investors in an economy, what we really do need to see is, whichever government is re-elected, we need to see some sense brought back to the budget outcome. We need to see on a recurring basis the Australian budget brought back into surplus, and then we'll be in a position to see some more ambitious, hopefully, infrastructure problems dealing with the growing population pressures that we're seeing across the country. Now I have another question here relating to arrears, and this is from John. Thank you. So broadly speaking, it's a long quote. I'll just quickly summarise it. Essentially, what are we seeing with borrower arrears in the Australian economy? Well, the latest figures from S&P dealing with the RMBS market, they're from end of July. They show arrears actually coming off a little bit, lowering off a very off what is a relatively low basis anyway. That's certainly on a sort of a trend basis what we see in our portfolios. Arrears on a trend basis are low. They're stable. Month to month they'll increase or decrease. I mean, that's largely a statistical artifact. There'll continue to be some volatility there. But we see broadly across the Australian economy, and certainly with our portfolios, credit standards being very strong. and unemployment remaining at low levels. So we see this, broadly speaking, as a benign environment for arrears. Now, that is, we've now come to the end of our time for this session. So I see I haven't managed to get to all the questions. So Ross, Tim, Jay, I'll attempt to respond to those questions following this teleconference. So thank you for providing those. And thank you, ladies and gentlemen, for listening and joining us today. It's terrific to have you on board as always. We hope that this has provided you with some value and some insight into the thinking of La Trobe Financial at this point in the cycle. As always, we look forward to continuing to work with you and to deal with you into the future. So, ladies and gentlemen, thank you very much, and that concludes the investor call presentation for today. Goodbye.